Term life insurance is a tool to manage the financial risk of untimely death. By purchasing a term life policy, you effectively assure your beneficiaries a payout if you pass away during a specified period. It's a contract. You pay premiums, and the insurance company promises a death benefit within a fixed term. A common choice for many is the term life insurance, which typically covers 1 to 20-year terms or up to a specified age. Most insurers stop offering coverage beyond age 75 or 80 because the payout risk is higher. The policyholder, who pays the premiums, can name a beneficiary, someone the death benefit will support. There are different types of term insurance. A single life policy insures just one individual, whereas joint first to die covers 2 or more people, paying out on the first death. Consider Sandra, who bought a term policy to leave a legacy to her son. Once she passes within the policy term, her son will receive the financial benefit. Term policies are cost-effective and flexible, notably cheaper than permanent insurance. However, the premiums can increase with age, and coverage often stops if you outlive the term. Term life insurance ensures protection when you need it most, especially if finances are tight or for covering short-term obligations like mortgages.